Good morning from London. I'm Kriti Gupta alongside Guy Johnson and Valerie Tytel. We're an hour away from the opening trade. Here's what you need to know. U.S. President Donald Trump said he would immediately halt all trade negotiations with Canada due to an advertisement featuring his predecessor, Ronald Reagan. We're going to dive into the details. Meanwhile, the White House is gearing up for a series of meetings with its Chinese counterparts ahead of the trade truce expiration, eyeing concessions on soybean purchases and rare earth exports. And of course, one eye on the stock market. They are marching higher, powered by mega-cap tech gains ahead of delayed American inflation data. That's set due to drop today, Val.
Well, we are adding to those gains of Wall Street. S&P futures are pointing 0.25% higher. It also was a strong handover from Asia. The MSCI Asia Pacific hovering very close to record highs, up another 0.4%. There was some excitement in Chinese tech and Hong Kong names on that Trump-Xi meeting, that date that we got confirmed next Thursday. Euro Stoxx 50 futures also feeling the excitement in the green to start the hour. The countdown to the opening trade starts right now.
Actually, on November 1st, the tariff on China goes to 157%, which is record-setting territory. And we don't want that because it's not sustainable for them. They can't sustain that. We don't want them to have to go through that.
So it's on. The meeting is on. That's going to be one of the major events that we are going to be watching, and expectations are building towards that meeting between Trump and Xi. My problem is that actually I think probably the base case here should be that we get an extension and we don't get the kind of tariff hit that the president is talking about there, and we get some sort of a deal maybe done on rare earths. But is it going to move the ball significantly forward, this meeting? I don't know. But if the ball isn't moved significantly forward, is that enough just to take the risk off the table that we get a worst case outcome? And that's actually what the market fears at this point. Steady state, as steady as she goes, feels quite good for markets at this point.
It does. I'm not sure an extension would be well received, given that there is still that looming threat of going back to some sort of 150% tariffs that we had seen earlier this year between the two nations. That being said, to the point about the rare earth exports and the idea of having kind of mini deals around it, I think it's unlikely you find some sort of consensus between these two economic powers on tech or IP or some of the other kind of sticking points. But a small win might be just what the doctor ordered. And I think that's really crucial when it comes to those conversations. We might get more of an insight come Monday because Scott Bessent is meeting with Li Feng, I said that right, I think.
Chinese counterpart.
His Chinese counterpart in Malaysia this weekend.
And I think this, or at least what we can maybe parse from the fact that we've got a date confirmed, is perhaps these working groups, these discussions going on before this meeting in Malaysia are going quite well. At least, why else would Trump want to schedule in a meeting? So I think things are looking pretty good, at least momentum-wise, in between these negotiations between the U.S. and China headed into this Malaysia meeting this weekend. Four-day talks, though. It's going to be a substantial amount of time they're going to be sitting down before this Trump-Xi meeting.
Define good, though. Is just an extension of where we are now good?
Well, I think the market is tempting that we could get a real breakthrough at this point.
And when the headlines dropped, we did see the market move positively. There was a risk-on move when that dropped.
Sure, because you're taking, because there was risk that it wouldn't happen. So you take, you can arbitrage. So you arbitrage that out. You take that out of the position, and therefore you're in a position where it is going to happen. So the risk is therefore that we do get either an extension or a bigger breakthrough. But both of those two things are upside, not downside.
You have to think about, what the market was worried about, which was a divorce, essentially, between U.S. and China relations, and that looks less likely to happen. So we take that tail risk out, and I think the market is feeling very comfortable.
Absolutely. Even if the base case is just continued, we can work with that, and we can work our way through it. So here's the way I'm thinking about this morning. If the Canadians have worked out how to push Trump's buttons, you do wonder whether the Chinese are going to be well ahead. Take a listen to this. This is this Canadian ad that has caused President Trump overnight basically to call off all trade talks with Canada. Take a listen.
The way to prosperity for all nations is rejecting protectionist legislation and promoting fair and free competition. America's jobs and growth are at stake.
Ronald Reagan used there by the Canadians to poke holes in Trump's argument around trade. The fact that they've used Reagan, and yes, I'm sure there's been some creative editing here, but the fact that they've used Reagan and they're aiming to play this ad in Republican regions just kind of speaks to the idea that there's the button, this is how we know how to push it. Trump has reacted. And I think there's another thing you can take away from Trump's reaction is that he's clearly worried about the Supreme Court.
Yeah.
He's clearly nervous that you could see the Supreme Court pushing back. He's saying this is ahead of the Supreme Court. They're trying to influence the Supreme Court. They're trying to make the point to the Supreme Court that this is not good for U.S. business, and therefore actually the Supreme Court should strike down what I've done on tariffs. So there's a number of different takeaways. But my takeaway broadly is if the Canadians can figure this out, the Chinese definitely can.
Well, the proximity to, in terms of the timing and, of course, the region and the language is really not working in Donald Trump's favor. The Supreme Court ruling, you're talking about the IEEPA ruling that's coming up, that would potentially eliminate some tariffs, although there has been reporting that there are backup plans by the White House to put in the same tariffs through different legal mechanisms should this ruling happen.
But it would just create some volatility around that issue.
Yeah, but maybe you can think that Trump supporters will push back on this, saying that, look, Reagan was saying that in the late 80s. When did we let China into the WTO? Yeah. The early 2000s.
Do you think it's going to be that sophisticated?
When was free trade ruined? By China letting them into the WTO. So
Maybe. But clearly Trump has reacted. That's all. I get all that. That's almost certainly all a kind of legitimate argument. But such a violent... This is an advert that not Canada, Ontario has decided to deliver. And the violence of the reaction by Trump, I think, is really fascinating. Not fascinating, it is instructive.
Well, we want to talk about a violent reaction. We can talk about a surprise CPI release later this afternoon. That could definitely be something.
Is it a surprise that we're getting CPI?
That could, a surprise to the CPI. And it's a nice surprise that, yes, we are getting a bit of U.S. economic data out from the BLS today. But note that we have seen a decent Treasury rally headed in to the CPI report today. The equity market does seem to be on a better footing, at least in the last few sessions. There are a few things for me to watch in the CPI release, one of which being the most important, tariff pass-through. There is still a lot of questions on what exactly we're waiting for. Did we already get it? Is it going to be hitting? What kind of components is it going to be affecting? So watching the components around goods inflation, I think, will be key. There is some speculation we could see some inflation when it comes to autos. Now, autos are different because, yes, they've been hit hard by tariffs, but normally companies don't raise prices until they release new models. Yeah. So perhaps that could be a delayed reaction we could get in the later half of the year.
Isn't the real risk here, though, that there is an argument around housing, there's an argument around goods inflation. Goods inflation may just be a one-time hit, but it's there and it's going to show up, but you can largely ignore it. Isn't the risk here that actually it's the services side of the economy that produces the surprise on the upside? Because that's something that's much harder to ignore. And there has been evidence, I appreciate that it feels like a long time ago, in some of the recent data prints that there is still services inflation within the system. I'm wondering where the surprise comes from here.
Yeah, exactly. And I think the other thing to watch out for is data quality, because frankly, we've seen a rise in imputations over the last few months. And given the shutdown is still happening, the October CPI release that we were expected to get in November is essentially highly unlikely to get pulled together. And the thing about this that our own Anna Wong was writing about is if we skip a month of CPI, some of these components, the data is only collected on a bi-monthly basis. Some of these components have lags. So that could be something that could affect CPI until May 2026 in Anna Wong's mind. So this reality that even though, yes, we are getting some data, there's going to be a lot of pushback on whether it's telling the true story of the U.S. economy.
I just had to look up what imputation meant. Just to remind myself.
Assumption.
Basically replacing missing data with substituted values that you are basically folding into the numbers and trying to figure out actually the reality of the situation. Let's talk a little bit about what's happening with the data this morning. Beaten a raise from Natwest. It has delivered this morning. This is a very stable kind of institution. Obviously, we think back to its long history where that has not necessarily been the case, but it has been recently, and it's been one of the banks that has been sort of delivering. But a beaten a raise, it's going to be interesting to see how the share price reacts to that, which has done very recently, as you can very well recently over the last year. Elsewhere, what are we watching? Keep an eye on chip stocks this morning. I think they're going to be an interesting story. And I think probably what we're also going to watch out for today is Saab and some of the defence stocks on the back of that story as well. So we'll keep an eye on some of the industrials out of Europe. We're going to talk to Saab a little bit later on in the programme. The earnings picture going quite well so far? Is that our feeling? It feels quite balanced here in Europe. I'm not entirely convinced that it feels as positive maybe as I thought it would be going into this set of numbers, particularly out of the States as well.
Did you see the Tesla shares actually ended up yesterday after all this talk about the plummeting profits on that mine? But we did get Intel out yesterday as well. The stock was up some 7% after hours. So it does seem like there is still discussions on whether it's going to be a strong earnings season, at least for big tech. But a lot of them still have yet to report. We get a huge amount of them next week.
Yeah. Next week's going to be fun. Next week's going to be amazing. What are our takeaways from this week, though? Crypto's been under pressure. That's something you want to pay attention to. Gold has cracked. Nice double top on the gold chart that's worth maybe looking at. It's come down to around 4,100, and it's kind of going sideways. What is our take? Is the momentum story beginning to fade in key assets? And is that going to take us further into other assets? Because obviously momentum's been a big driver in equities. You can only look at the factors that have really outperformed this year, and that's been the main one that has delivered. Yeah,
well, I think at least when it comes to the U.S. earnings picture, one thing that has surprised me is how well the autos have done. Essentially, the shift away, the negative impacts of tariffs have been mitigated by the deregulation from the Trump administration when it comes to gas guzzlers, and we saw that with GM. So it's interesting to see how the impact of tariffs versus the positive impacts from deregulation. I mean, you could talk about that in many sectors on how that balance is playing out.
Americans still like big cars.
Yes, they do.
Be my takeaway. Anyway, what have we got coming up? Haig Bathgate, Cullinan Capital CEO, is going to be joining us to talk about what's happening broadly in these markets. Camila Corsell is going to be joining us, BNP Paribas Markets 360 Developed Market Rates, Strategy and Economics Head Europe. We'll get her take on, A, the data we're about to see out of Europe, because remember, it is PMI data today. Got to watch for that a little bit later on, but it is also CPI data out of the United States. I'm going to keep a firm eye on what we should be watching there ahead of the Fed. Shanti Kellerman, Seven Investment Management co-CIO, joining us in the next hour, as is Maria Demertzis, the Conference Board Economy, Strategy and Finance Centre Europe leader. Again, I think we'll talk to her just after the PMI data has hit. And we're going to be speaking to this gentleman. Michael Johansson is going to be joining us a little bit later on, the CEO of Saab. How many next-generation fighters do we need in Europe? How well is the Gripen selling around Europe and around the rest of the world? Which contracts are we watching for? What's happening on drones? A lot of questions for Michael a little bit later.
Well, let's take a look at the risk events on the horizon. We do get a lot of data today. The global flash PMIs are out across the globe, starting this morning with ones out across Europe. We also then shift attention to the U.S. at 1:30 p.m. UK time. We have U.S. CPI. We also get University of Michigan sentiment survey later in the day. And then later in the evening, the Coalition of the Willing is set to arrive in London for discussions over the weekend, and that follows the EU leaders meeting yesterday.
Minus, I think, Macron. I'm not sure he's going to be here. Be interesting to see whether he does actually show up. Anyway, what else do you need to know? It's Friday morning. What else do you need to know? The European Union has put off a decision on whether to tap frozen Russian central bank assets to aid Ukraine's war efforts. Talks amongst the Bloc members stalled after Belgium demanded greater assurances that it would not be held liable for risks linked to the proposed loans. Sources tell Bloomberg the goal is still to get a final agreement by year end. The Binance co-founder Changpeng Zhao has received a pardon from President Trump. Trump told reporters that he pardoned Zhao at the request of, quote, a lot of good people, though he has never met the man himself. The move marks the latest act of clemency the White House has granted to a crypto entrepreneur, underscoring how the Trump administration has positioned itself as a friend of the industry. And Bloomberg has also learned that banks are preparing to launch a record $38 billion debt offering to help fund data centers tied to Oracle. Our sources say that JP Morgan and MUFG are leading the efforts, which is split across two senior secured credit facilities. A $23 billion package is said to be aimed at financing a data center in Texas, while the other facility will help a project in Wisconsin.
Coming up on the program, any post a third quarter beat. We'll check in on the Italian energy company at the opening trade. Plus, of course, a quick check on the defense stocks as well, as we hear from the EU defense chief, who's urging the use of investment loans to finance spending in the sector. But up next, we go right back to the macro markets, especially ahead of that U.S. inflation data we were just discussing. We're going to dive into the details and what we can expect later in the session. If you have any questions of your own for us or for our guests, get involved in the conversation. IB plus BBTV Go is the function on your terminal. This is Bloomberg. 42 minutes away from the opening trade here in Europe. There's a lot to digest, but I would argue today's kind of a sleepy Friday, maybe a little bit of a drop in volume. Maybe the focus is over in the space, especially when it comes to the data center. Valerie Tytel is here. Val, walk us through it. What are we expecting?
Well, look, a return to some U.S. economic data. The Bureau of Labor Statistics will be releasing the delayed September CPI release at 1:30 p.m. London time later today. It kind of feels like a payroll Friday, headed into a lot of volatility, headed into the weekend. But a few things to watch in this data release. The first key one is essentially the goods inflation, the tariff pass-through. What kind of clues will we get in today's release? Will we see maybe an upside reading in goods inflation showing that these companies are passing on tariff costs to consumers, or we could also get the opposite, that maybe the consumer isn't strong enough in order to take these kind of price increases and has been pushing back. Maybe we see some people offering discounts. The other thing to watch is housing rent inflation. Now, there has been some high frequency data of late that has pointed to housing rents becoming soft, and this could have a decent drag on core CPI if we start to see that turn. Also, just a reminder on data quality. This is something that's going to be quite key moving forward, given we're still having a government shutdown. The BLS has not yet essentially collected data for the next CPI release. So we could essentially be skipping a CPI data print in November, and that could cause some issues with data quality moving forward. But if we think about the themes of this month, it's been one of a fixed income rally. Those U.S. 10-year Treasury yields are down 15 basis points since the government shutdown began on October 5th. We're now just flirting below the 4% mark. A hot CPI print today could definitely change the theme of fixed income to come. The other theme we want to keep our eye on is big tech earnings. Now, it's been a bit of a mixed picture this week, but the recent one from Intel showed a positive story. Intel returned to profitability and gave an upbeat revenue forecast. So after hours jumped nearly 8%, adding to its gains of nearly 90% year to date. Guy?
Yeah. Helps when you have a government taking a stake in your business, maybe. That certainly seems to be the takeaway. Strategy, though, where's the strategy? OK, what have we learned this week? What are we going to learn next week? What is the CPI going to tell us today? Joining us now, Clásico Capital CEO Haig Bathgates. Haig, thank you for joining us. Thanks for stepping in. Look, it's been a really interesting week on so many fronts. We've seen gold cracking. You've got crypto on the move. You've got a whole range of corporate earnings coming through. Just at the end of this week, as you think about how maybe you are looking forward, has anything changed?
Yeah, look, uncertainty is the theme of the day, isn't it? I mean, it's been a really sort of volatile couple of weeks, gold cracking, as you say. I think the really interesting thing is you've had so many people calling the top of the market, but this earnings season has shown you that the results are actually being delivered with, 80+% of companies beating expectations. So, the bears are going to be sort of licking their wounds. And I think at the moment for us, there's a lot more risk in being out of the market than actually being in the market. So, I think the evidence has come through, and we're seeing strength in areas like AI, data centers, in all of the hot areas. We're actually seeing a follow through in terms of earnings now.
Do you think the momentum, though, has started to be questioned? It's certainly been questioned in crypto and in the precious metals complex. Are other areas that have been driven so much by momentum going to be under pressure?
Yeah, I think so. I mean, the way that we play is we just back the big winners, the Mag 6, the Mag 7, it feels like quite a boring way to do it. But there are obviously lots of companies at the periphery, the Palanters, companies like that are on kind of crazy earnings that are going to have to do incredible things to even meet expectations. So look, we're evidently in a bubble. It's just a question of how far in that bubble we are. And I think at the moment, we would be avoiding things that are on the price to sales type ratio argument, because that's needles in a haystack stuff. You might get it right, you might get it wrong. Areas like nuclear energy on all these areas, as we've seen, can be incredibly volatile and starting to crack this week.
Hey, in the last, I want to say, weeks or so of earnings, the conversation, it feels like, at least here in Europe, has been that there have been a lot of companies, Volvo Cars is a great example, that have shown a really amazing turnaround story when it comes to operating profit. It feels like the market is rewarding margins on the upside, but not punishing companies when margins are compressed. Is that a problem?
Yeah, I think just general sentiment seems to be pretty positive at the moment. As you say, that the companies that are maybe not doing quite as well are not being punished as savagely as they were sort of earlier in the year. So, everything is sort of pointing in a bullish manner. I think that's just the sort of weight of money argument that, people are quite bullish on stocks generally. and it's the area to be. And across the board, we've seen pretty resilient markets. It's not just in areas like technology. We had LVMH reporting strong results as well. So just generally, it's quite a positive environment to be in. To us, we're pretty comfortable holding equity markets at this level. To us, the risk area is in government bond markets actually more than equity markets at the moment.
Do you think the bond market is driving this equity market? The fact that we haven't seen major moves or volatility and maybe a little bit of complacency and things like the 10-year and arguably European debt as well, that maybe that stability is helping this equity market?
Yeah, I think so. I think particularly in the US, it's obviously the US which is driving sort of the global weight of money into the markets. And despite the sort of the sort of very public sort of Punch and Judy act with Trump and trade talks, I think the market's now become kind of used to that. But yeah, I completely agree. I think there's a lot of complacency when it comes to government bond markets, and particularly in Europe. France, being probably the canary in the mine, but the UK is right in the firing line, I think, and doesn't have the European construct to help it. And of course, politicians are never going to volunteer cuts in public spending and so on. So it'll have to be the markets that call that out. So the danger zone to us, remains areas like, UK long duration government bonds at the moment.
Haig, I want to ask a question on how AI has been impacting these earnings releases, in the fact that, I think the market may be expected to hear from businesses that they're seeing cost efficiencies from using AI in their businesses. Is that something that surprised you, or you think is maybe missing this earnings season?
Yeah, I think it's exactly right. We've been caught on that as well. So we were starting to buy sort of mid and small cap US companies on an expectation that we're going to see the implementation of these AI technologies enhancing earnings. So we haven't seen that to any great extent yet. And obviously all of the moves have been in the sort of people providing the data centers. It's the chip manufacturers like Nvidia that have moved up incredibly 110% from the April lows. So yeah, that has really surprised us in terms of how we haven't seen that follow through. But I do think it's just a matter of time. And I think we all use ChatGPT, we all use Copilot, and it is making a very, very tangible difference. So I think it's just there's a bit of latency before that starts to be implemented. But certainly that's I think has been the surprise that we haven't seen that follow through.
And Haig, you mentioned that the risk in your mind is higher yields. We just got some news that Oracle is looking at a $38 billion bond issuance potentially next week. Is that something that you'll continue to monitor, how these companies raise this financing?
Yeah, I think so. I think if I was a company like Oracle, I think it's a very, very astute move to raise as much capital as you can in long duration bonds. You can see we're now pricing in a full % cut in the US. Are we actually going to see that by March? I'm not so sure. So obviously the follow through to companies is if you're in very tight credit spreads, which is another feature of the current environment, I would certainly be raising capital now if I was in Oracle's position.
All right, Haig Bathgate, CEO at Callanish Capital, giving us a little bit of a world tour and a cross-asset analysis of what we're seeing in these markets. We thank you so much. Coming up on the program, go right back to the trade tensions. Talks terminated with Canada. We're going to dive into the details next. Stick with us. This is Bloomberg. "30 minutes away from the start of the opening trade. It's Friday. It's that Friday energy. And you're kind of seeing it when you look at the futures picture. Green on the screen, but not massive moves when you look at the S&P futures. A little bit of a rebound in Eurostoxx 50 futures, higher by 0.5%. I think our focus, though, this morning, Val, might just be on the FX space. Dollar CAD, a little bit stronger.
Let's take a look at the fixed income open across Europe. Yields are holding in pretty well. We have seen a run up of higher yields, and that's off the back of a higher oil price yesterday. We had treasuries underperforming around 5 basis points across the curve. We're opening up pretty steady ahead of those European PMI prints coming out later this morning.
Absolutely. Kriti was mentioning, though, what is happening with the loonie. You are seeing a reaction this morning in markets to the latest spat between Canada and the United States. U.S. trade negotiations with its neighbour, Canada, are apparently this morning in chaos. That's after President Trump announced that he was immediately ending talks with the country. In a post on Truth Social, the President of the United States wrote this: "Tariffs are very important to the national security and economy of the USA. Based on their egregious behaviour, all trade negotiations with Canada are hereby terminated." The President has apparently taken issue with an advertisement funded by the government of Ontario that includes excerpts from an address President Reagan gave back in 1987, in which he defended the principles of free trade and slammed tariffs as an outdated idea that stifles innovation, drives up prices and hurts U.S. workers.
The way to prosperity for all nations is rejecting protectionist legislation and promoting fair and free competition. America's jobs and growth are at stake.
Go back and watch the whole speech. I think that's probably a useful thing to do this morning as well. Obviously, there's a little bit of editing that's gone on, but nevertheless, clearly, Ontario is under the skin of President Donald Trump. Joining us now to talk about all of this is Bloomberg's Mark Perrier. Why this isn't Canada, this is Ontario that is doing this, and they've clearly figured out that Reagan is the way to do it, the voice of Ronald Reagan.
Using the iconic voice of Ronald Reagan, quite a flashback there, but trying to get the message to the heartland of America that these tariffs are potentially hurting Americans as well. Ontario, why Ontario? It is the economic powerhouse of the country, and Doug Ford is the premier and has obviously taken on the whole challenge himself, probably angering the Prime Minister a little in the process.
How does this impact the Canada-U.S. trade negotiations? What's really at stake here for both the parties?
Everything is at stake. Canadians will be waking up this morning to renewed tensions. The markets will be waking up to renewed tensions between both countries. They are each other's largest trading partner. Mm-hmm. There's a lot at stake. Is everything wiped off the slate? Perhaps not. I'm sure there'll be a lot of diplomatic efforts that take place today, and I'm sure Carney will be getting involved in the whole saga today.
Talk to us a little bit about just what Canada's doing beyond U.S. trade here. I mean, to your point, Carney has been trying to get these talks on the agenda for quite some time. In the meantime, he's been busy talking to his peers in other parts of the world.
Absolutely very busy. The Prime Minister has been traveling a lot internationally. Some Canadians have criticized the fact that he's spending so much time outside the country, but his vision is to develop better ties with other countries, not to be so reliant on the U.S. But you cannot separate Canada from the U.S. I mean, that's just a fact. And obviously, there'll be a lot of scrambling today to make this work.
You would have thought you couldn't kind of shift the UK from the EU, but we managed to achieve that one, so you never know. Mark, nice to see you. Thank you very much indeed. Mark Perrier joining us on the latest. Should we call it a storm in a teacup? Maybe. We'll wait and watch between Canada and the United States. This takes us on to obviously the wider tariff chat, which I think then takes us on to the CPI chat. So it's going to be interesting to see what tariffs are doing within the CPI data a little bit later on. Mm-hmm. How significant are they going to be? There's also the kind of the fiscal side of things, which is Trump is referencing the Supreme Court ruling, which is coming up, which is a kind of big part of the fiscal package that he's trying to push forward to change the narrative around the fiscal position the United States has. But I think the CPI story is going to be really interesting. How much tariff is there going to be? What impact is it going to have? Where is it going to show up, if at all? And can we discount it as a one-off factor? Yeah,
and look, we have these negotiations between the U.S. and China over the weekend with Scott Bessent and his counterpart. And then this date on the calendar with Trump meeting Xi. Yeah. And if that does not go well, we're looking at 157% tariffs in between the U.S. and China. Will that impact people's outlook for CPI, given maybe businesses are still on tetherhooks of whether perhaps their costs will be increasing over the coming quarters?
That uncertainty creating hiring pauses, hiring freezes in a lot of places. You're seeing that already start to show up in some of the labor market data. But then it feels like it's also sticking inflation right back on the table. That does not make things easy for the Fed at all. Our next guest, of course, has that take ahead of today's inflation data. Camille de Courcelles, head of European Developed Markets Rate Strategy and Economics at BNP Paribas, joins us around the table. Camille, if you were Jay Powell, what would you do here?
Well, I think he's been pretty clear that there will be a series of cuts. He does not disagree with the market, and we don't expect today's US CPI data to be one where we will see a lot of pass-through from tariffs, actually. So we think it will take time before that really materializes. It's probably more a story for the end of the year, start of next year. And also, we would expect a bit of pullback from elevated shelter prices from August. So we rather see the risk to US CPI data to the downside today, so nothing that could really derail Powell to deliver another cut next week.
Is there a connective tissue here between the U.S. government shutdown and the funding issues there and the monetary policy? Or is this still a long-term story when it comes to rates?
So we think it's still two very different stories. But when it comes to next week, we think the focus will probably be more actually on the balance sheet, given that, the market is very well priced for a cut. But there is mounting pressure in funding that has been happening, not related so much to the government shutdown, but October and November is a period where you have a lot of bill issuance, and at the same time, the balance sheet has actually shrunk quite a lot. If you look at reserves as a portion of GDP, you would see that we have broken through 10%. And this is exactly the sort of levels when, back in 2018, we started to see some pressure on front-end funding with more volatility, with more widening pressure in spreads, cheapening. So the question is whether the Fed should not act as soon as next week and completely end QT.
Do you think that maybe they'd move up the end of the QT timeline because of what's happened with regional banks just last week?
I mean, is it enough? Maybe not so. If you think that it is only idiosyncratic, you probably ignore that. But looking at the broader picture, yes, it could also contribute to the Fed deciding to be more dovish on the balance sheet side of things as well.
And you mentioned that you are expecting a soft reading when it comes to shelter inflation or housing inflation components. Is that something you see as a long-term trend? And is that because of Trump's immigration policies? What's driving that?
I mean, it's more like seasonality plus the surprising trends that we've had so far. So that's where we would expect some pullback. But at the end of the day, the broader picture will indeed be more about tariffs-induced inflation. And looking at the market again, inflation risk premia is very compressed. So once that happens, when you start to have upside surprise to inflation, we think it could have more of an impact on longer dated yields rather than to the front end.
Can I turn attention to what's happening here in Europe? We're going to get PMI data pretty shortly. We're going to get an update on, therefore, what is happening with the European economy. Politics has been the dominant factor over the last few weeks. Can I buy French bonds now? Is that okay? Is the coast clear? Can I do that again? What do you think about what's happening with gilts as we march our way towards the budget? What does the European government bond picture look like?
So I would say it's a bit twofold. On the one hand, we expect a lot more supply will come out of Germany next year. So that would rather still require some vigilance, and we would expect German yields to continue to push higher over the longer run. But what we would like to buy in the current environment, UK gilts, yes, we think that peak bearishness is behind us. French OATs, we would expect actually to remain in a very stable range as we go into the end of the year with the budget passing. If the budget does pass with a deficit target of below 5%, it would actually be very good news. I think no one were expecting that 2 weeks ago. And if that materializes, then we would expect more tightening from here with a return to 65 bips versus Germany.
Do we get another ratings review coming up? Is it today?
France? Tonight,
it's
yes.
Tonight, actually. It's tonight. So our view for tonight is no downgrade.
Right.
I mean, the outlook is unstable. So the first step for Moody's will be to move to outlook negative.
Yep.
And we think it's a 50-50% chance.
What will be the impact of that? The market's already priced that.
I mean, honestly, for a year, we kept saying to everyone, OATs are already trading in line with a full downgrade to single A.
Right. So even if we get a downgrade, there won't be much of an effect.
We've seen the price action after Fitch. We've seen the price action after S&P, and they have downgraded to single A. Moody's we won't see a downgrade tonight. So I would just reiterate our view that the market is already there.
Great to see you. Thanks for stopping by to see us this Friday. We'll look forward to that a little bit later on. Kmita Korsel, Head of European Developed Markets, Rate Strategy and Economics at BNP Paribas. Let's talk about what we're going to talk about next as the EU continues to look for ways to finance Ukraine's war effort. Here's the bloc's defence chief on funding drone defence.
This part of drone wall was evaluated by those 4 countries that it would cost around of 1 billion euros. Okay. With detection, with anti-drone capability. So that is, of course, it's quite a substantial amount of money, but it's not something. It's not hundreds of billions.
Coming up, we're going to be talking about defence companies. We've got Saab that we need to be focusing on. There's a nice picture of the Gripen. We'll talk to its CEO a little bit later on, plus keep a broader look at what is happening in the defence space, what's going on with Rheinmetall, etc. We'll focus on that next. This is Bloomberg. Welcome back. 15 minutes to go until the equity market opens here in Europe. We're up pretty much across the board this morning in terms of what we're looking at. US futures are pretty poppy as well. S&P's up by 0.6%, Nasdaq's up by 0.9%. We've just about filled the gap between the 10th and now, which I think is worth looking at in terms of the futures picture in the United States. Let's talk about what the rest of the day is going to look like. CPI is going to be a major factor in these markets a little bit later on. Val was joking, it feels like a payroll day. You can't, today's not a day for a long lunch. Bloomberg's MLive, Scarlett Montgomery-Koenig joining us around the table. We're all going to be focused on this. Haven't had data for ages. What is it going to tell us?
Yeah, I mean, this is the hard bit, right? We have inflation data coming in. I think the feed through to the equity market, the main channel is how it impacts your expectation for Fed funds. Yep. So what you tend to see is if you get a hotter than expected inflation print, that means you need a higher discount rate. That impacts earnings and therefore equities to the downside. Whereas if you get a downside surprise, you get the opposite impact. Now, the bad news is I think there's a much higher bar to price in more dovishness for the Fed than more hawkishness. So you have a terminal rate currently priced that's 3%. That's in line with dots. That's essentially where the Fed sees neutral at. So to go more lower than that or more dovish than that, you have to say essentially you're entering recession territory, which seems unlikely but also isn't great for stocks. Yep. Whereas you have an ability to price in more hawkishness. What I would say, though, in terms of good news, is that the expectation is quite high. So implicit in that is this idea that the market assumes the Fed is putting more priority on the labor market rather than inflation. So if you do get a hot print, you might just see a wobble in equity markets rather than something bigger, especially given that you won't have the Fed coming out. They're in their blackout period. You won't have any kind of like hawkish commentary to go with that hotter print.
I was on WEI, not WEIF. Just going to point out the futures are up a little less than I said. 0.4% on Nasdaq.
You're talking about the equities market. Talk to us a little about the bond market here. I'm looking at 399 on the 10-year. It's kind of been in like a weird 5 basis point range, I want to say, all week long. Does this print change that?
I think it's really hard for this print to change it because there's so much emphasis being put on the growth story, on the labor market, because there's this idea that inflation, if it's tariff-driven, might be transitory, which seems like a big mistake given that we've had this transitory inflation story before. I will say you got a little bit of a feed-through in terms of a higher oil prices, higher break-evens. I do think at some point either you need to price a higher Fed funds, which pushes up your real yield in terms of terminal, or you need to admit that you're not going to get back to 2% inflation anytime soon, which means your break-even rises. So I think certainly you need to see higher yields as inflation comes in hotter. I just don't necessarily think that comes today or even really in the near future until we get some kind of sign that inflation isn't just going transitory, it's actually having longer term impacts.
Skylar, it's a big week next week. There's a lot of weekend risk with these U.S.-China discussions. Do you think there's a risk you could just see profit taking after this report, regardless of what it is?
Yeah, I mean, this is the thing with valuations is by themselves, they don't predict your equity returns whatsoever. But what they do is they make investors more nervous. So what you tend to see is when equity valuations are elevated, they stay elevated for long periods of time as earnings come in strongly in an expansionary period. But when you do get a sell-off, the sell-off tends to be harder. So I think it's a reason rather for vigilance instead of selling off altogether, and it's something certainly you need to pay attention to, is that negative catalyst.
All right, Bloomberg's MLive strategist Skylar Montgomery-Koning, thank you. And remember, you can get up-to-date analysis and insight from Skylar and the rest of the team. Just go to MLive Go on your terminal. Let's switch focus over to the EU. The European Union has put off a decision on whether to tap frozen Russian central bank assets to aid Ukraine's war effort. Talks among the bloc members stalled after Belgium demands greater assurances that it would not be held liable for risks linked to the proposed loans. We're joined now by Bloomberg's Oliver Crook from Berlin. Oliver, what's behind this deferral?
Yeah, so listen, Valerie, let's give them a little bit of credit where credit is due. They did actually manage to get the 19th package of sanctions against the Russians through. They actually managed to do that even before the meeting began yesterday, which was not really a foregone conclusion. There were a number of objections from a number of member states. Those got cleared, so that package got through. That will mean, in terms of significant moves for the Europeans, they're going to put more sanctions on more of the Russian shadow fleet. They're going to crack down on more of the Russian sort of crypto trading. A number of the financial institutions were also targeted. But critically, this is the full adoption of that LNG ban they were talking a couple of weeks ago, where basically now they will not be permitted to have any LNG coming from Russia into the European Union by the end of next year. The problem is that is by the end of next year. That is 14 months away. And what they really have, the final bazooka for the Europeans, are those frozen Russian assets, 140 billion euros worth of them, that are sitting mostly in Belgium. And the real sort of conflict there for the Belgians is they do not want to be held liable. If something happens in the coming years, they need to repay those assets back to the Russians. There is some kind of legal problem. They want to guarantee that risk is diversified across all of the member states that are guaranteeing that, and not just them, which is, I think, a fairly fair thing for them to want from this. The problem is, whenever I talk to policymakers, and I spoke to the European Defense Commissioner yesterday about whether or not they're going to get these frozen assets moving by the end of the year, basically no one wants to commit to that. This is a conversation that gets kicked into December for the last European Council meeting, where that discussion will happen. I'm not sure that they will come to a consensus, though, even then.
Ollie, what else can we do? What else is on the table? What else can be used to fund this war effort?
Yeah, so exactly. The Russian assets is seen as a sort of long-term solution, right? $140 billion. Why this is so important is this is for Vladimir Putin, basically the guarantee that the Ukrainians can continue to pay for this war. In the shorter term, you have these safe loans that the European Commission has put out. All of the member states need to put their projects forward before the end of next month, and that will get those loans put forward, and some of those loans are going to flow to Ukraine. The longer-term picture, though, this is the sort of main point, and this is what we heard from the European Defense Commissioner yesterday. Have a listen to what Kubilius had to say to me yesterday.
Coming into defense on European continent. Those amounts will come, first of all, from national defense spending, if member states will fulfill what they promised, in NATO agreements, to raise their spending up to 3.5%. I hope that member states will fulfill that. If they will fulfill that, then during the next 10 years, we shall have an amount around of 6.8 trillion euros for real defense. For equipment, it will be maybe half of that, 3.4 trillion, but those are quite a big amount of money.
So really the sort of long-term question here, I think, is the question we had from the very beginning, guys, which are talking about 7 trillion euros worth of spending. Can that be achieved without joint debt? That answer is still not before us, but it's something we'll be continuing to ask them over the coming months.
Bloomberg's Oliver Crook out of our Berlin bureau. We thank you so much. Let's go from the macro and the geopolitics to some of the micro stocks that we are watching. Chloe Melly is all over it. Chloe.
Good morning, Kriti. Let's start with technology today, and more specifically suppliers to Intel. So Intel over in the US rallied quite massively, as we can see yesterday, after providing quite an upbeat revenue forecast, and that indicates that it might be on the right track to recover after what has been quite a tough year for the company. So this boosted the shares of Intel suppliers over in Asia, and we'll see if we get the same in Europe today. So some of the key names to be looking out for are ASML in particular. So it derives about 9% of its revenue from Intel, so quite significant. But also smaller suppliers like BE Semiconductors and Siltronic could be moving higher on the back of this sort of longer-awaited comeback from Intel. Moving on to Natwest, and Natwest raised its income and returns guidance this morning and also delivered its highest earnings in at least a decade. So this could be boosting the shares in the bank this morning after what's already been a very, very successful year. As we can see, it is the third UK bank to be reporting this week after Barclays and Lloyds earlier, and they all seem to to be saying that the UK customer so far is resilient. So we'll be seeing how that moves the picture this morning. And finally, Sanofi has reported earnings that beat estimates thanks to really strong sales of its blockbuster asthma drug Dupixent. This could be moving the shares higher after a little bit of weakness in the stock. However, one weaker spot was vaccine sales, with the CFO saying there was quite negative sentiment around vaccines and maybe a post-COVID fatigue setting in as well. So that would obviously be a little bit of a challenge. So let's keep an eye on Sanofi this morning.
All right, our equities reporter Chloe Melly walking us through some of the stocks to watch this morning. I mean, it's fascinating. We had a really interesting earnings story. It's going to kick up into high gear next week, of course, as well on both sides of the Atlantic. So we'll probably get a bit more clues about what's actually driving this market, whether we can even call this week a success.
We haven't filled. So get back to the 10th.
You're all about the gap.
Yeah, really.
But equities. But this takes me back to the momentum story.
Yeah.
There has been a lot of momentum in these markets. You've seen that come out of the crypto trade this week. You've seen that come out of the gold trade this week. Equities have just basically gone sideways. The headline I read this morning was tech powers stocks higher. Yeah, we're basically where we were back on the 10th. So. Is the record highs. Yeah, I agree. But is the momentum coming out? Anyway, the opening trade's next. This is Bloomberg. Welcome back. A couple of minutes to go, and then we're going to start trading here in Europe this Friday morning. Yesterday's session in the United States certainly ticked up as the day went on. We were up by 0.6% by the end of the session. Europe went out around here. We've got all of this, therefore, to price in on the other side. Europe needs to figure that out and punch it into its futures picture this morning, which, Val, looks all right.
It looks fairly positive to end what has been a fairly positive week for global equity markets. Euro Stoxx 50 futures in the green, up nearly 0.5%. FTSE 100 futures up 0.1%, and DAX futures in the green as well, up 0.3%. Kriti?
Plenty of stocks to watch. Defense, of course, key in that when we look at the DAX. But a couple of individual stocks that have also started to report earnings. Natwest, for example, lifting their guidance. Their third quarter profit beating estimates, likely to be received fairly well at the open. Their highest earnings in at least a decade. This is enormous. We'll see if that is just a read through to NatWest shares or even beyond to the broader banking sector. Sanofi as well, very much in focus. Remember, you had a lot of the healthcare stocks take a little bit of a beating this week. Some of that is a vaccine story, but for Sanofi today, their profit, another rise. Record Dupixent sales seems to be the story there. But when we're talking about a sector basis, do these individual earnings pieces start to feed into the broader sector? Is healthcare still the defensive trade that perhaps it was 6-8 months ago here in Europe? Of course, defense very much front and focus. We do have one eye, Guy, when it comes to the conversations happening in Brussels, the frozen assets, as well as any sort of deals and ceasefire negotiations made with Ukraine, Russia, the United States. I believe Zelensky, Merz, and Keir Starmer, of course, all meeting here in London today. The coalition of the willing. We're going to talk to Saab CEO a little bit later on. We'll get the update on the defense picture here in Europe from him. Right, let's get an update on what's happening with these markets. Here we go. Friday's session is open. Let's show you what the numbers look like. The FTSE 100. It's going to be interesting to see how NatWest trades through. Keep an eye on chip stocks as well. I just want to flag that one too as being a factor for these markets this morning post Intel, though it wasn't a great day for European chip stocks yesterday. Some of the names that we follow under a little bit of pressure. So the IBEX is up by 0.2%. The FTSE is fairly flat. It's been a choppy week, obviously, for the gold miners, which is another factor you need to fold into the FTSE. It is now up by 0.2% as some of these stocks begin to kind of get going. I think we're going to have to wait maybe for the DAX this morning, but the CAC is already up by 4.5%. Val, what do you got?
Look, when it comes to the sector's picture, technology jumping out as the best performing sector so far. We have ASML, the biggest points gainer, up 1.25%. So the maybe positive read through from those Intel earnings last night. They did give quite a rosy forecast, and we're seeing a read through into European tech this morning. It was also quite an interesting session and a good session for Asia tech as well. So that move seems to have gone global. The rest of the sectors, we do have a few at the bottom of the basket in the red. Basic resources is one of them that comes after yesterday. We had such a huge jump in oil prices, so maybe giving some of those gains back. We also have consumer products and utilities at the bottom.
There's lots of individual movers we want to keep our eye on, though. You mentioned some of the tech stocks. Sanofi, of course, having a fantastic morning, higher by 4% and climbing as we speak. We should mention Accor as well. This is, of course, the hotels and hospitality firm. They announced a buyback this morning, so they're seeing quite a bit of love as well. But some of the outperformers, especially in luxury from this week, they're actually underperforming today.
Yeah, Kering's definitely fading, isn't it? So it's had a massive move. Unsurprising, I think there was a bit of a short squeeze maybe in yesterday's positioning. It rallied quite strongly. I think despite the fact that it's hit a series of 52-week highs recently, I think the market has been still unconvinced. Yesterday we saw, obviously, it moved sharply higher. I think you're just fading a little bit of that move as well in terms of the market move that we're seeing this morning. You're also seeing some of the energy names coming off the boil a little bit. Big moves there yesterday. But ASML, Sanofi, Siemens, Safran's out. Safran's out with I think it's the third upgrade that Safran has delivered this year in terms of its outlook on revenue. It's up another 1% and it's moving the market higher in France as well. It's a fairly decent mix of stocks. But some of the big moves yesterday, some of the squeezy stocks yesterday, I feel like they're unwinding maybe a little bit this morning.
I mean, we're still waiting for an opening trade in Natwest after they raise their guidance. So we'll keep an eye on that, perhaps moving the FTSE when it does open. But let's broaden out this conversation. And joining us around the table is Shanti Kellerman, the Seven Investment Management co-CIO. What has been your take on earnings season so far?
I think it's been a solid start, and we have lower expectations for this quarter than we did Q2, which is obviously helpful. I think it's going to be more about the forward guidance than what is actually delivered, particularly in the U.S., because everyone is so focused on the forward impact of that tech spending and things like that. Europe, I think you'll probably see companies more reaction to the actual earnings and less focus on that guidance, just because the market's focusing on different things for those companies.
We still have a lot to come. Yeah. What is your eye really focused on for the remainder of the season?
Well, obviously, it's the tech earnings. And because that's such a huge portion of the market, and it also has so many reverberations through, if you look at, semiconductors, through all of those supply chains. And increasingly, the tech sector is becoming more entwined with the infrastructure sector as well. And I think that's something that will naturally broaden some of the market returns, because a lot of those companies' fortunes are getting very intertwined with the hardware systems, the data center construction, which are just going to need different types of companies to help build that infrastructure.
There is a meeting between Scott Bessent and his Chinese counterpart this weekend. There's a meeting between Donald Trump and Xi Jinping next week. How are you thinking about trade negotiations right now between the world's two largest economies? Does it even matter at this stage?
So I would say, we get loads of questions in from customers all the time. Tariffs are really not coming. No one's asking about it. I think there's just mass fatigue. Now, it doesn't mean it doesn't matter. Things can't happen that aren't important. But I think there's a lot of fatigue in the market about it. And I think it's kind of the pattern we see as we have, these really harsh things come in, then we roll them back and we all have a huge sigh of relief. And it's hard to see why you'd expect anything dramatically different this time. I think they'll probably will roll back on some of those, 100% massive tariffs, because it's not really in anyone's long-term interest.
What is the worst case scenario here? What is, if clients aren't worried about it, the market isn't worried about it, what's the risk we're not seeing?
Well, yeah, so obviously I think we've had quite happy markets, elevated valuations. We certainly could have a pullback. I think if that happens, I wouldn't see it as the start of a huge fall, because there's a lot of cash still on the sidelines. There is still economic growth. People still have money. So I think I would view anything as a correction, a temporary thing, not the start of something more sinister.
So what's going to move things around next week? You've got the meeting, Trump and Xi. You've got the Fed. You've got a whole boatload of earnings that are going to be. Which of those where should I be looking in terms of where I think things are going to change?
I like earnings because I know they're real, they're audited. You look at a lot of surveys these days, consumer surveys, everyone in the UK says everything's awful, but then it turns out we all spent more money last month.
Yeah, I know. Never believe what a consumer tells you. Believe what they actually do.
Yeah, and then same thing, do I necessarily believe what Trump tells me, or do I believe what actually...
Yeah.
And even if we have some grand agreement next week, does that all unravel a month later? So I think for me, it's the earnings is what I'll focus more on.
Momentum has been a really big theme in a lot of different asset classes, and correlations have been kind of quite high. People are in the same basic trades. If we see momentum unraveling in one area, let's call it gold, crypto, there are a few others, do you as an investor go, I just wonder whether or not actually there's going to be some other momentum trades that are beginning to fade a little bit here? We've pushed up a long way. Is there enough momentum to keep equities moving?
I think it's very reasonable that we have a bit of a pause in momentum. You can't keep going up forever. But we also, one thing we talk to customers about, you have to be comfortable with being at all-time highs, because in the long run, if markets go up, you need to be at all-time highs quite a lot to keep going up. So it's not necessarily a bad thing or a warning sign to just because you have an all-time high, we should be worried. I think gold has certainly had a great run. I think you wouldn't be surprised to see a pause in momentum. But the longer-term factors on central bank buying, other countries worrying about, can the U.S. seize all of my assets if they decide don't like me? I think those are still firmly in place. And then it's about, can we keep delivering earnings? And the outlook for that is pretty solid. Not entirely certain, but I think there's a plausible case to get there.
A couple of stocks I just want to flag. Talking of delivering on earnings, Natwest out this morning, and its numbers are certainly delivering on the upside. You've got Natwest up by nearly 6% this morning. Saab is also moving massively to the upside as well. It's up 6-7%, I think. We'll talk to its CEO very, very soon. But yeah, you're seeing a big move. There you go, 5.61% to the upside.
Big move for Natwest, touching a 15-year high.
Yeah.
Intraday high, I should say, up 5.3%. So the earnings keep coming in great for the banking sector, both on this side of the Atlantic and over on Wall Street. I do want to ask a question more on deregulation. We've seen that impacting the banking sector in a positive way, even impacting some of the auto names in the U.S., even more to the detriment that tariffs have already caused their business. Do you see that as a key factor, at least for this momentum in U.S. equities moving forward?
Yeah, I think deregulation absolutely can be a tool to take costs out. So you've got tariffs putting costs in, regulation taking costs out. I think the pace it's happening is very slow and piecemeal, because in some ways you get, I work in a bank financial institution. The FCA says you're pulling back this regulation. We all kind of sit there and go, are they really doing this? How far back can we go? Can we really row back as far as we were before that came in 5 years ago? So I think it takes time, and you need not just the regulation to change, but you need kind of evidence of the regulators' behavior changing before companies will truly go back to where they were before.
Shanti, you talked a lot about economic growth, resilience, earnings, et cetera. How much of the estimates or even some of the resilience and optimism that is baked into this market is dependent on energy and oil prices staying stagnant? That seems to be the major question when it comes to European sustainable growth. Does that apply for global equities?
I think it's, Europe is certainly more sensitive, and we have higher energy prices in Europe than we do in the U.S., and that's always going to be a bit of a competitive disadvantage for some of those European industrials. There's probably room for oil to go up a little bit without, crashing the global economy, and I think that's probably why we saw some of those sanctions go in on, Rosneft, where you could do that when oil's at 60. Your willingness to do it at 90, 100 isn't there. So I think there's a little bit of space, but higher commodity prices are essentially a drag on global growth, earnings, consumer spending. And so I think we've got to be conscious of there's a little bit of space, but if that goes too high, then I would certainly view that as a negative going into next year for economic growth.
How are we feeling about credit? We're starting to see cracks appearing in the credit market. People are worried about it. Certainly not at the kind of high-end stuff, but obviously at the lower-end stuff.
I would say one interesting thing, we've started to get questions from retail customers about private credit, which, is not an asset class.
Should I be investing or should I be avoiding?
Yeah, I think First Brands triggered a lot of that, of just people going, what on earth is this? So I think it's kind of interesting that's made it into that retail conscious.
So the First Brands has made people more popular. So it's made private credit.
People ask about it.
About whether or not they should be putting money in it, or whether or not it's a risk to the system.
A lot of it's, do you own this? If I'm honest.
Okay.
But so I think in that part of the market, it's largely in the institutional space, and it's not pervasively in retail portfolios. So if you have a crack there, I think it can be weathered quite well. If we look at the corporate market, you have to remember the high yield market today has a far higher credit quality than it did 10, 15 years ago. So I think people, when they say, oh my gosh, spreads have come down so much in high yield, you have to remember it's a better quality high yield market than it was. It probably should have lower spreads. And I think in the corporate world, we still don't see much risk, particularly in the large caps. A lot of them are still benefiting from those, the average rates they're paying are coming down quite slowly and they're adjusting. So yeah, there's nothing I see that really worries me in credit markets.
Cool. Nice to see you. Thanks for stopping by to see us. Shanti Kellerman, Seven Investment Management's co-CIO. Thank you. Let's take a look at the core six this morning. What are we watching in Europe? Defence stocks certainly feel like they're on the front foot. Rheinmetall, as you can see in the middle of the picture, is up nicely. But it's tech really to the right-hand side that is delivering that right-hand side move. Schneider's also up quite nicely. Defensive stocks, let's call them Nestle and Novo Nordisk, a little lighter this morning. But we are starting to see a little bit of a kind of rowback maybe on some of those luxury names that we've seen big moves in this week. Let's find out what else we are watching. The banking sector remains front and centre for Chloe Melly.
Good morning, guys. So, very positive movement for Natwest this morning. It is up 4% after raising its income and returns guidance and also delivering its highest earnings in at least a decade. So the profit pre-tax beat estimates by a massive margin. This is actually the third UK bank to be reporting this week. We had Lloyds and Barclays earlier, and all of them upgraded at least part of their guidance and seem to be signalling that the UK customer is able to weather those economic headwinds a little bit better than expected. We do have the budget coming next month, so that might change a little bit. But in the meantime, Natwest is doing really well, and that is really driving the shares this morning. Moving on to another positive story, Sanofi is also up this morning after its profit beat estimates thanks to really strong sales of its blockbuster asthma drug Dupixent. It did flag some weakness in the vaccine segment, with the CFO saying that there was a little bit of a negative sentiment around vaccines and lower vaccination rates in the US and elsewhere. But it seems that the market is really focusing on that Dupixent momentum instead of that vaccine weakness, and we are seeing the shares up 3.2% for Sanofi this morning. Moving on to suppliers to Intel. So ASML and B Semiconductors are both up this morning after Intel over in the US provided quite an upbeat revenue forecast and seems to be signaling that it is making really good progress on its turnaround. And those two here in Europe are suppliers to Intel, and we are seeing that read across, and they are moving higher on the back of that. Moving on to Accor, which is a hotel operator. It is up this morning after raising its guidance and also unveiling a €100 million buyback. So the raised guidance was because of better cost management, and that seems to be rewarded really well by the market. We are up 5% for that hotel operator. And finally, just one bad move this morning to talk about. Well, there's other ones, but the ones that we're talking about here. Signify is down 7%. It is a lamp manufacturing company. It cut its forecast, and that was due to weakness in the US, and that is being not rewarded at all by the market. It's taking quite a hit on the back of that. We're down 7%.
All right, Chloe Melly from our equities team walking us through some of those early movers. We thank you so much. One earnings story that we haven't hit yet is Saab. Coming up, we check in on those earnings. Of course, the market reaction there looks like a positive one at the get-go. Shares higher by about 7% this morning. The CEO of the Swedish defense aerospace firm joins us live from Stockholm for an exclusive interview. Coming up next, stick with us. This is Bloomberg. Breaking data coming out of France, crossing the Bloomberg terminal. The French October composite PMI falling to 46.8. The forecast was 48.4. If you look underneath the hood and look at where that pain point is, it's very much in the services space. The services PMI falling to 47.1. The forecast 48.7. Compare that to manufacturing, actually rising to 48.3. Forecast of a 48.2. You're already seeing the euro start to take just a little bit lower. And anecdotally, when you look at the data set, it looks like they're talking about sustained political uncertainty as well as some geopolitical uncertainty as well. That's weighing on that services number. We'll see if that comes back. But based on the political situation, Guy, I'm not sure if it will.
We need to flag that a little later on today, we are going to get the latest rating review of France. Will that be meaningful? There's a lot priced in, but you can still see a shock, as we've learnt over the last few weeks. Let's turn our attention back to what is happening with the corporate news this morning. Beating a race from Saab, the company raising its full-year organic revenue forecast as it reports third-quarter earnings that beat. The Swedish defence and aerospace firm also sees full-year EBIT operating growth to be higher than organic sales growth. Joining us now is Michael Johansson, the CEO of Saab. Michael, a beaten a raise, market likes that, stock is up very nicely. The company is clearly humming along very nicely at the moment. Do you see the kind of momentum that you're delivering at the moment being sustained?
No, absolutely, and that's why we raised our guidelines for the full year as well on the top line side. The organization is delivering in a very nice way. And of course, we needed to see that the capacity investments that we've done over the year and the last years before this is now coming into play. And that gives us the strength to deliver in a much higher pace than we have thought before. And that's why we are raising our guidance now. So I'm really pleased with the delivery rate of the organization and the execution of all our projects that we have in the company today. And we have a huge backlog as well. So that's all about why we have raised our guidelines now.
In terms of pushing forward, you've got a big backlog. You've told us that. Clearly, there's a lot of interest in buying the product from the company. Can you just give us an update on some of the contracts, though, that you are bidding for currently, what your outlook is and what your expectations are for further Gripen sales?
Well, I mean, we have more campaigns that we've had for a long time now on both the Gripen and the Global Eye, the airborne early warning. So we put a lot of effort into that now not only being selected but also contracting in these campaigns. So I look forward to that, but it's always a political decision, I have to say that, in the end on these big mega deals. So it's relationships between countries, and prime ministers and defense ministers will be involved to decide in the end. So it's not only about the product as such, which we have great products, there's no question about that, but there's a high intensity also on the campaign side in a number of countries. And you saw President Zelensky and his delegation coming to Sweden this week and handshaking with our prime minister to support development towards an air force in Ukraine over time where they prioritize the Gripen E, which is great news to us. So now we can start that planning. I have to say, though, that doesn't mean we have a contract. There's still a way to go, but it's a good sign of where we need to go.
Michael, can you talk about, you mentioned you have this record high order book. What does your capacity look like to keep up? Do you see any choke points in your process?
Well, I think we are investing heavily to continue to grow the company and manage its capacity. What we are maybe battling a little bit with where we see pain points is, of course, in the supply chain, which I think is true for many of the defense industries, that we have to bring with us the companies that supports us going forward and also invest in the supply chain to make this sort of capacity growth happening quickly as possible. So that is the main thing, that we need to have the supply chain and the ecosystem of companies going in the same direction. But that's been quite good as well. But there are pain points, of course, in that supply chain.
Are rare earths a pain point in that supply chain, Michael?
Rare earth is absolutely a concern over time. If not Europe, US, Australia start really getting this in progress and creating sovereign capacities ourselves, this will become a problem, of course. We are not seeing any sort of effects as of now, and we have the majority of the order backlog secured when it comes to these things. But, I mean, of course, I'm concerned not only for the defense industry, but also for other industries. So we have to get a trade deal together with China, but we also, of course, need to get Europe and US and Australia as examples to also get sovereign capacity on this side. So concern long term, but not right now.
OK, so just to be clear, Michael, you have enough capacity currently to deliver what you need to deliver in terms of the order book you currently have, in terms of the rare earths that you currently possess. So it may not be you, I'm assuming this is probably further down in your supply chain, has the material needed to deliver on the product that you have committed to thus far?
Yeah, that's in general terms, if you look at the whole picture, we have a lot of things secured for our backlog. But that doesn't mean we look into this in many levels now, because you're right. I mean, this is further down our supply chain, and we talk a lot more to the suppliers now to make sure that this will be sustained over time. So that's what's been happening now. But my view right now the data that I get is that we have secured a lot of this now for the backlog that we have, but still, with a number of years ahead, we need to have this in place so we can continue to grow. So it's about years, not months or weeks that we get into trouble, but it needs to be sorted.
Michael, we've got FCAS, we've got GCAP, we've got the Gripen, we've got a number of different programs that are underway at the moment. Rare earths are another kind of area of interest in this space. Do you think Europe needs to do more to share? Do you think we need to be more coordinated in our approach? Like, what is Saab doing versus what is Dassault doing? What is BAE Systems doing in terms of the rare earth sourcing? Do you think we need to work together more? Is there that level of coordination that is happening? And does there just more broadly need to be more coordination? There is ongoing stress within the defence space at the moment about who should be building what and whether or not we're overbuilding and whether or not we've got too much of one product or another product. Is Europe doing a good job of kind of coordinating the effort to rearm?
Now, my view is that we have to do more together to create scale, but also to share the burden for investments going forward. It's based upon sort of having common acquisitions between countries in Europe, aligned requirements, and that can be done. Industry would support that to work more together going forward if that happens. But also when it comes to supply chain issues, of course, being the head of ASD, the Aerospace and Security and Defence Organization in Europe, I also push for that we now come together as industry supporting and giving our view of what the Commission needs to do to secure sovereign capacity in certain important supply chain issues connected to RE or components or what have you going forward. That is very important that we have a consolidated view on that, and we push for that, and we invest in that going forward. So it is important that we do things more together, generally speaking, in Europe to create more strength and deterrence and capacity going forward. No question about it. I'm for that, and I'm for collaboration. Yeah.
Michael, just one final quick question. Have you had any recent conversations with either Airbus or Dassault or what is happening on the GCAP side? Kind of where are we, do you think, in that process? You've told me before in the past that maybe you'd be open to talks. Is there anything recently happened on that front?
I'm just monitoring what's happening on GCAP and SCAF to two different big programs to see what happens. But of course, I mean, to us, I've said that before, to us it's important to retain the systems integration capability, the OEM capability as a company. And we are open to do collaboration. If we can do that and still retain that capacity and capability, we will collaborate. Or we can continue doing it on a sovereign basis. But of course, we discuss these things when we meet. But I'm not saying I'm involved in the GCAP or SCAF. We're just looking what's happening. There might be other things, of course.
All right, thank you. That was Michael Johansson, CEO of Saab. Well, coming up on this show, we'll check in on those European PMIs. We'll have German PMIs breaking right after the break. This is Bloomberg.
Welcome back to the opening trade. About 30 minutes into today's session, green on the screen, but not by much. We've really pared back some of the opening gains that we saw just 30 minutes ago. Your outperformer still at the broader index level, but again, we are barreling towards negative territory in just 30 minutes, Guy.
Absolutely. In terms of the internals, 354 up, 226 down. Slight balance towards the up and down. It's Friday. I'm going to put the volume down to the fact that it's Friday. We're a little light on the volume. Let's talk about where the leaders are. So this is where it gets interesting. Corporate earnings certainly playing a significant factor in terms of what we're seeing in terms of the narrative to the upside. Sanofi is up by 3.1%. Natwest is up by 3.3%. You're also seeing maybe some read across coming out of what we saw yesterday from Intel. ASML is up by 1.4%. 1.4%. Doing nicely on the back of that, adding some quite large amounts of weight to the upside. Vinci is down, GSK is down. Let's take a look at what we are seeing on the laggard side of things. SAP also giving back a little bit of ground as well after some big moves earlier on in the week. GlaxoSmithKline, is that just a rotation maybe out of GSK into Sanofi? I don't know, but GSK maybe balancing out what we are seeing in the pharma space this morning. Val, what else do we need to know?
Here's what else we're monitoring this morning. Intel shares rallying in late trade after the chipmaker returned to profitability and gave an upbeat revenue forecast. It expects fourth quarter sales to come in around $13.3 billion, which is just below estimates. But the outlook suggests Intel is on the right track following a turbulent year. The CEO, Lip Bhutan, has recently secured an investment from the U.S. government and backing from NVIDIA and SoftBank. The loonie is falling after U.S. President Donald Trump says he would immediately halt all trade negotiations with Canada. Trump made the announcement in a Truth Social post, citing an advertisement against his tariff plan featuring the voice of former President Ronald Reagan. And finally, the European Union has put off a decision on whether to tap frozen Russian assets to aid Ukraine. Talks among the bloc members stalled after Belgium demanded greater assurances that it would not be held liable for risks linked to the proposed loans, which many are held in Brussels. Meanwhile, Ukraine's President Zelensky and other European leaders are gathering in London today for the Coalition of the Willing discussions on Russia's invasion of Ukraine. This is as Russian Air Force plans crossed into Lithuanian airspace yesterday. Kriti?
In the meantime, as we monitor all of those stories, we are getting breaking economic data crossing the Bloomberg terminal, this time coming out of Germany. Just about 15 minutes ago, we got it out of France. The October composite PMI numbers rising to 53.8. The forecast was 51.5. Their services numbers coming in very strong here, rising to about 54.5, forecast of 51. Manufacturing PMI also rising, but again, kind of in line with estimates, 49.6 there, forecast of 49.5, or I guess 0.5 is a better way to say it. You are seeing strength in the euro off the back of it, 116. Enormous that you are seeing this much of a strength and jump in the services PMI relative to the French story 15 minutes ago. That's where the pain point was.
That's a 29-month high on the services number.
Yeah.
It's a 29-month high on the comp number as well. The question is how much of this is premised on the idea that we are going to see this pickup in German spending? We were talking about German debt a little bit earlier on. Is the Merz fiscal package, when does it start to kind of really deliver? Is it going to start to deliver? There's a note, I think, floating around this morning from one of the German banks talking about potentially it fizzling a little bit.
Yeah.
There's a lot baked in, a lot of expectation around what is going to be happening with this German debt story.
Yeah, Commerzbank monitoring that very, very closely. Let's get another view on this conversation. Maria Demircis, leader of Europe's Economy, Strategy and Finance Center at the Conference Board, joins the program. Maria, pleasure to have you as always. In the last 33 minutes, we've had two major data sets, one from France, one from Germany, telling us two very different stories. Your initial thoughts?
Yeah, indeed. On the French side first, that came 15 minutes ago. I was hoping that the fact that we averted elections was going to stabilize the PMI. Unfortunately, it didn't. It just goes to show that the budget really is crucial, and the fiscal position of France is in the mind of all business leaders. They're expecting tax increases at the end of this year with the new budget. All of this, of course, has a negative feedback on what they think about the economy, and we saw it in the numbers today. So I think this will stay with us for some time. By contrast, Germany, that's very good. So, last month the numbers surprised on the upside. They continue to surprise on the upside. We're going to stop thinking that this is a surprise anymore and actually expect to see some robust recovery. For the moment, it's just the services that is doing now. I'm hoping that manufacturing will also help on the back, of course, as you said earlier on the fiscal spending that will come from the German government, very much on defense and of course, on all the companies and technologies that will have to benefit from that. So good news from Germany. I'm hoping that will continue.
Good news from Germany, but as you pointed out, Maria, on the French side, you are seeing that weakness. In the report, though, it talks about and attributes some of that weakness to a lot of the political uncertainty and just how long that may add. We're not seeing a major reaction in the bond market this morning when it comes to the spread between those two, but we have seen plenty of credit downgrades when it comes to France as well. How does France recover from this, short of electing a new leader?
Yeah, I think what they need is a robust budget. I think that's the only way it can recover. Something that will have a buy-in, and that's where the difficulty is, but something that will indeed help with the French economy. There are indeed problems with the fiscal budget. At 5% at deficit, it's just not sustainable. We need something that is convincing to all of us, including, of course, the business leaders, that actually France will be able to deal with its fiscal position in the years to come. That's the real big question. For the moment, it hasn't convinced, and I think a lot is at stake with the budget before Christmas.
Maria, we had a recent poll of economists conducted by Bloomberg that showed that a majority of economists think the ECB will be on hold not just for 1 year, but for the next 2 years, so through 2027. Do you agree with that kind of sentiment from your peers? And what kind of narrative would really be the thing to change the dial on that narrative?
Yeah, I think there's two things here, right? One is the inflationary thing, of course, that the ECB is looking at. Inflation is a problem that is actually resolved right now. We're in very good territory when it comes to inflation in the euro area. By contrast, this is not the case in the UK and the US. So I think that's good news. And then the question is growth. Can we have better news on growth? We are at 1% almost in the euro area, forecasting a little bit more for next year. I think this is what we need. If we have a convincing fiscal package and money that is coming to to Europe from the private sector that can convincingly invest in Europe and bring us out of our own troubles, that of course means that the news will be better, and we can actually explain this view of the interest rates staying where they are. If the growth news, however, are not as good as they could be, then we might have a change in the interest rates. For the moment, I share this view. I think we are in good territory. It's just wait to see the promise of growth and where it will come from.
Do you think the promise of growth could perhaps be dented if we do not get a breakthrough with these U.S. and China trade negotiations? We're having some taking place over the weekend, and Trump and Xi are meeting next Thursday. Do you see that as a risk to the European economy as well?
Well, absolutely. It's an enormous risk. The European Union is really in the middle of this. We saw it also with Xperia, the company that was, in fact, taken over by the Dutch government yesterday. This is all reactions to secondary sanctions, the possibility of secondary sanctions from the US, which is, of course, all due to the US China trade war. This is an enormous risk for businesses in Europe, for the supply chains, for secondary sanctions, and of course for their ability to invest. So yes, this is a very big problem for us.
Maria, the French president wants to take a much tougher line on China and wants to start using some of the more hard-hitting tools that Brussels has at its disposal. What would be the implications of that, do you think, for European growth if we would see a further deterioration?
Supply chains will be the biggest issue. The EU has always taken the position that we want open markets. Open markets means that we sell to these areas, both the US and China. And of course, we're integrated in the supply chains very, very tightly. If we were to take a tougher stance on China, all of this will suffer. We will have to bring some of that back, so shorten the supply chains. And none of this can happen in the next year. So we are talking about a need of retransforming businesses that will take anything between 5 to 10 years. So things will have to get worse before they can get better. It may be necessary, though, given the trade war between the US and China, but also the issue of economic security. In Europe, economic security now is a first-order problem. Think of rare earths. Yeah. Where are we going to use rare earths from for the defense industry and for the semiconductors? All of this depends very tightly on China, and I think our dependence on China needs to reduce.
Yeah, we just heard the Saab CEO talking about that very subject. Just find a quick question from me. A lot of the European optimism hangs on the idea that Chancellor Merz in Germany is going to deliver, that this fiscal package is going to be there. I'm not seeing it in the data yet. Maybe there's some evidence in the PMI numbers this morning, but the broader hard data isn't showing it as strongly as maybe you would have anticipated thus far. It is a story for next year, but people are questioning whether or not it is going to show up, whether it is going to deliver in the way that we all hope and dream of here in Europe. What is your view on this? Is there a risk that it doesn't?
It cannot. It has to. It has to deliver. And they said the threat from Russia is a real one. And by that, I mean defense and security. So, we have to take defense and security seriously, and therefore we have to deliver on this. However, this is Europe, and things are slow, and they're not optimal. They're messy. But they will have to deliver. Security is a first-order problem, and we can't really afford not to secure our borders. And I think this will deliver on Germany, but also on other countries.
Well, speaking of that pressure from the defense story, Maria, in the last 24 hours, we went from frozen assets being utilized from Russia towards Ukraine from that being perceived as a sure thing to getting stalled until December. It looks like Belgium having some concerns about liability around that. Can you just walk us through, one, the concerns, and two, the roadmap from here?
Yeah, so just on the concerns first, the frozen assets that we're talking about, the 140 billion, reside in Belgium with Euroclear. This is an institution that is under the supervision of the Belgian National Bank, and therefore it is under Belgian law. So therefore, if all of this were to unravel, it will be Belgium as the frontline country, borrowing from the migration metaphor, that would actually have to bear the wrath of the whole thing unraveling. So I'm not surprised that the Belgian Prime Minister is very tough on the way that it asks for security guarantees, because indeed the unraveling of this will be catastrophic. My own view is that it remains a very, very difficult issue to resolve. Now I think the pressure on security is so big that something will happen by December, but it is crucial that the risk involved with all of this is mutualized. By that I mean it is the EU that actually shares the risks. Belgium cannot bear the risk of this thing unraveling in the future when Russia goes to courts, international courts. I'm talking now 5 years down the line, not immediately. Again, there remains a question mark whether the EU collectively can bear the risk. I think this is something now that will happen, but it has to be watertight as far as Belgium is concerned.
Maria, thanks for the update. Thanks for the info. Maria de Mertzis, leader of Europe's Economy, Strategy and Finance Centre at the Conference Board. Thank you very much indeed. Let's turn attention back to markets. This year has been, and I say this with some understatement, a dismal year for London's initial public offerings market, with fundraising at a 30-year low and notable companies listing elsewhere. Bloomberg Originals has been looking at why the city's exchange has been losing its appeal.
Things look like they're going from bad to worse for London's IPO market. In 2006, more than $50 billion was raised during initial public offerings. But in 2024?
You can see that it is relatively healthy, and then it just drops off.
Particularly since 2008, we've seen a fall in about 40% of the number of companies listed in the UK.
The first half of 2025 has been the worst for IPOs since 1998, and that sounds terrible.
London falls out of top 20 IPO markets as fundraising slumps 69%.
In the global rankings, the UK is now all the way down here. And this is just one of a string of factors undermining London's more than 300-year-old exchange. A few green shoots have begun to sprout under London's trading floor, but buried beneath a financial malaise decades in the making. This is a story important to ordinary people as well as investors. But just a heads up, it's not a happy one.
It's a shocker, isn't it? It really is.
That was the weekly doc on the drought of London IPOs and it falling out of the rankings of the top 20 areas to IPO as a country. Now, IPOs and M&A activity generally does feel like it's done well this year, at least this quarter. And there's been a lot of attention not just on equity raising, but debt raising. And I think that's going to be a key story going forward, at least when we talk about how these hyperscalers, the likes of Oracle, how are they going to be funding these pledges for all this infrastructure spending when it comes to data centers?
Yeah. You're going to see the Oracle one go through a little bit later on. What is that going to tell us about this story? There are data centers, and there was a really interesting piece in the Journal yesterday talking about how much money data centers actually produce in terms of returns to shareholders. Like, these are expensive things, and you wonder when you look at this debt, what kind of rate of return do we think these businesses are going to produce off the investment that they're putting in? Like, it sounds really easy. Build a data center, generate decent returns. Yeah. I think Oracle's numbers are already being questioned. Other data centers that are out there have struggled. You have to make ongoing investments into these things. It sounds straightforward, given the boom that we're seeing at the moment. But at the end of the day, can you make money?
But put that $38 billion into perspective for you guys. That is huge. Essentially the size of a new 10-year reopening for U.S. Treasuries. It's a massive amount of duration. And I think the market, maybe not now, but will begin to start questioning, is there enough appetite to finance this via traditional debt structures? Yeah. We also know that maybe corporate credit and private credit, will be taking some of this burden in order to finance this next rollout. But it's really a lot of questions over, is there going to be the appetite, and is there going to be a tipping point where the market thinks that's too much debt, that's too much leverage?
Yeah. Well, that's a cautious view on this. The other point of this is that if you are worried about debt sustainability, if you're worried about some of the fiscal issues around the world, and you're looking for safe corporate credit to put your money into that would lean in on the momentum thing that you're seeing in the equity market, this kind of debt sale could be your answer. And it brings me back to the kind of the era of COVID, where the Apples, the Amazons, the Microsofts of the world were borrowing at rates that were akin and very close to the 10-year Treasury. That
was the software. This is a different beast.
But it's the same liquidity argument.
Maybe. I think those are very different businesses you're talking about in terms of funding. And can you make a rate? What is the rate of return that this stuff is going to kick out? I think is a key question in terms of what debt sustainability story it's going to have to work with.
Yeah.
If you are the margin on software for these companies is enormous. Mm-hmm. And also they are so cash generative that basically they're just, it's a debt's so cheap, we should do it, we should return money, we should buy back shares. It's a cash management exercise, whereas this is for a piece of kit that they are going to have to put into the ground and make a return on. I think it's a different argument.
This might be something that we'll get clarity on in hindsight, maybe not necessarily in the moment. Coming up, we're going to talk about the other thing that's hitting the wire later today, the long-anticipated U.S. CPI data, the only print ahead of the next Federal Reserve decision. Before that, I want to leave you with a little bit of sound. KKR co-founder Henry Cavras told Bloomberg that he sees no systemic risk when it comes to private debt. Let's hear what other Bloomberg TV guests have had to say recently on that very subject.
If the punch bowl's being taken away, only a couple people may have noticed it yet, but so far it's still partying like it's 1999 in the credit markets for the most part.
I worry about those firms that don't have a driver's license, that have decided they want to get into private credit, have no way to drive, haven't passed a test or anything, and will they have problems? They could.
This is not a private credit story. These credits were bank-led, they were bank-originated, they were bank-syndicated, so we can't really understand why there's a referendum on private credit.
Welcome back to the opening trade. We're 51 minutes into today's session, and it does seem like the momentum is beginning to peter out. We do have some indices flipping into the red. The DAX in the red. We also have the CAC 40 in the red. Eurostoxx 600 is fairly flat at the moment. But looking over to their U.S. peers, it is still positive for U.S. futures. S&P 500 futures up 0.2%. NASDAQ futures up 0.3% after some solid gains of yesterday. But let's look ahead to risk events on the horizon. We still have some more PMI data to deal with. We did get a weak French PMI, a strong German PMI. We're about to get the Euro area-wide PMI dropping in 9 minutes' time. We also get the UK PMIs at 9:30. The US ones are released later this afternoon, but most of the attention will be on the CPI released at 1:30 p.m. London time. We also get the University of Michigan consumer sentiment. So any readings on the U.S. economy, the market is essentially desperate for amid this government shutdown. Later today, we also have the Coalition of the Willing arriving in London. But let's go back to the U.S. CPI report. The September data on consumer prices is slated for release at 1:30 p.m. later today, following a 9-day delay due to the ongoing government shutdown. Joining us for more on this is Bloomberg's Rachel Evans. Rachel, how do you think the markets are going to interpret this data today?
Well, I think you kind of nailed it in your intro there. I think markets are just desperate for any kind of colour on what's been going on in the economy. Now, it's worth noting that this report obviously comes from September, so that's prior to the shutdown, but just some kind of window into how the economy was performing before we got that shutdown, I think will be very, very closely watched. In terms of how the market's going to react, I think, obviously we're all looking ahead to the Federal Reserve meeting next week. It seems like a rate cut next week is pretty much locked in for now, but there's a few question marks about what happens next. Obviously, there's a lot of pressure on the Federal Reserve to kind of continue cutting rates. And if we do see a hotter inflation print coming through today, that could start to kind of shed some doubt, perhaps, on that potential path.
Well, sticking with that, what do you think matters more here? Do you think it's still the CPI print that we might get later today, the inflation story, or is it still the labor market that the Fed is focused squarely on?
Yeah, I mean, I think the labour market has been kind of front of mind for the Fed for a long time, and you see that in a lot of kind of the commentary that comes out from Fed officials, that they are really watching for how the labour market develops. But given we had kind of like the news on oil this week with sanctions, I think inflation is coming back into people's focus. If we do see some of those kind of pressures from higher energy prices kind of creep back through, that is something that could potentially be a problem for the Fed and also for kind of markets who have been assuming that inflation is getting under control and that the path is clear for those cuts.
Where's my volatility next week going to come from? Is it the Fed? Is it Trump-Xi? Is it the earnings? Mag 7 reporting a lot of numbers next week. Kind of, what's going to be? Where's the biggest probability of a volatility event going to come from?
I wish I had a crystal ball.
I know. That's what I'm asking you for.
I would say that you're probably most likely to kind of see this either kind of off the trade headlines that come out of that Trump-Xi meeting.
That's a wild card, isn't it? Like, who knows what's going to come out of that?
Completely a wild card. And I mean, we've seen kind of today with these headlines around Canada, just kind of like how small some of these things can be to prompt such a large reaction. We're talking here about sort of the trade talks with Canada being called off over an advert, effectively, right?
Yep.
So who knows what is going to be the kind of tenor of the conversation that we get next week and what that's going to do. We have seen the market is still very sensitive to kind of those trade moves, even as kind of like the S&P and NASDAQ have continued to push higher and sort of some of the weaker earnings have been shrugged off. You know, it's been those trade headlines that have really moved the needle one way or another in recent months. So I think that has the most potential. But if we do see some of those big earnings kind of come through and show some doubts about the future of AI as a driver of growth, that could also get people a little nervous given how frothy things are.
Rachel, we have the ECB and the Bank of Japan making their decisions the day after the Fed. The Bank of Japan has been known to surprise. We have a new prime minister. Do you think there's likely to be a surprise at this meeting?
So the expectation is really for a hold and then for a hike in December. That seems likely, just given I think, you know, central banks tend to try and avoid kind of really rocking the boat and to sort of like give sort of the market a bit of time to get on board with things so that you don't see too big a reaction. But you never know. I mean, there's been a lot of conversation about what Takaichi, the new prime minister, kind of thinks about sort of the Bank of Japan's independence and how she's going to approach that relationship. So I think people will be watching a little bit for some of the colour around the decision and what kind of like the messages from UADA about kind of how they're thinking about rate hikes going forward.
As you said, Dan, you said it's Friday, which takes us on to our next subject, which is what happens this weekend. Rachel, nice to see you. Thank you very much indeed. Rachel Evans looking forward to next week. Well, a little bit of this week. We've got the CPI number to get in. But it's the weekend. We're nearly there. It's been a bumpy week. I think we're going to need a lot of rest and relaxation this weekend as we prepare for next week. There's actually a few things out there. The World Series begins. That's baseball, right?
Major League Baseball.
Oh, my gosh.
US. Shall I remind you? It's also a very popular sport globally, shall I add? Japanese are crazy about it.
Rumour has it, yeah. El Clásico, football, probably a slightly more important event in terms of the sporting story. More people may be following that.
Real Madrid versus
Real
Barcelona.
Madrid. I know, it's a massive game.
Team Real Madrid all the way.
The Rome Film Festival, are we tuning into that?
No, because we're going to be watching El Clásico, obviously.
Okay, fine, fair enough. And then you've got what I think is basically the revival that they have at Goodwood, but down in Bologna, which is a very nice place to be hanging out as well.
Might I remind you that it is Canada versus USA in the World Series, and I know you're an aspiring Canadian citizen.
I am, yeah. Michelle Hussein has got a great conversation with Nigel Farage. Pay attention to that. This is Bloomberg.